Hello everyone, in today's video we're going to be talking about capital allocation, and in actual fact it's about optimizing capital allocation, because when investors want to invest in certain strategies they tend to distribute their capital evenly across the strategies. For example, if they're interested in investing in 4 strategies, they tend to automatically just put 25% across the 4 strategies, or if there's 5 strategies they'll do 20% across each, as an example. However, that might not be the optimal allocation to do so. And our team of amazing quants and developers have put together this tool to basically show you what the optimal capital allocation would be from our previous data across certain performance metrics, such as maximizing for Sharpe ratio, maximizing for Sortino ratio, or for minimum variance. And that's what we're going to be talking about in today's video, just showing you what the weights look like and how it can actually impact performance and minimizing drawdowns as well. So here we have the tool, and we're just going to use an example. We're going to pick 5 strategies that an investor might be interested in. So for example, let's add G14, V-XGB, V44, Crypto 02, and let's do V3X as well. So let's say our investor is interested in these 5 strategies. We'll analyze the assets, and what it will show us is the date that it's analyzed it from. So in this particular portfolio, it will be from the 19th of March 2024 to the current date, and it will show us how many trading days that is. Now, the reason it started at this date is because it has to date it back to the strategy that has the minimum track record. For example, we might have 4 strategies within there that date back to 2021, but if we have one strategy within there that goes back to 19th of March 2024, it can only calculate from that specific date. Okay, and what is printed out for us here are the overall returns for each of the strategies, and also we like to compare it to the S&P 500 and also US Treasuries, because that's just some things that our investors might also be invested in or looking to invest in, and they like to get a comparison to those markets as well. Now we scroll down a little bit, we have all the data available to us, such as the total return, the Sharpe ratio for each strategy, the Sortino ratio, the comma ratio, maximum drawdown, and obviously so much more data as well. Now, the interesting part, which we'll go into now, is actually the portfolio simulation. Okay, if I come over to the portfolio simulation here, we can see all of our strategies that have been chosen, as well as the S&P 500 and the US Treasuries. In this example, we're not going to be creating a portfolio that includes US Treasuries and the S&P 500, but it is good to have in case an investor comes to us and they have, for example, 10% of their capital already invested into the S&P 500. Well, we can actually calculate in the portfolio as well. But for this example, we are going to exclude those 2, and we're going to put them to 0. Now, to begin with, we're going to just do what an investor would automatically think to do. So we have 5 strategies here. Normally, an investor would just split the capital evenly across all 5 strategies. Okay, so we'll put them at around 20%, like so. And then what we'll do now is we'll simulate the portfolio based on this weight allocation. Okay, we'll simulate that, and then we'll see what statistics it will print out for us here on the right hand side if the capital was allocated to those specific strategies at 20% each. You can see over here that the maximum drawdown for this portfolio would have been around 8.59%, and the total return would have been around 91.43%. And you can also see the other statistics as well. Now look what happens when we actually optimize the portfolio for, let's say, maximum Sharpe ratio. We have minimum variance here, or maximum Sortino ratio. So we can say for maximum Sharpe ratio, this is the most amount of gain for the minimum amount of drawdown, or the minimum amount of risk. So we'll see what happens to these weights once we optimize for maximum Sharpe ratio. Okay, so we'll optimize the weights, and look what happens to this over here. So as you can see, for optimizing for maximum Sharpe ratio, we have been told by this tool that we should have 35% in XGB, 25% in Crypto02, and around 37% in V3X. And it actually has dragged down the G14 and the V44 all the way to 0. And it's telling us that for maximum Sharpe ratio, we actually don't need to be allocating any capital to those specific strategies, which is interesting because you would think that the more strategies that you were to invest into, the more diversified you would be. But in this case, it's basically saying that you don't need to invest in 5, you can just put it in 3 for the maximum return versus the risk. But anyway, let's actually now simulate the portfolio and see what happens to this maximum drawdown and total return, or any other values that you're interested in. Just take a look at the difference. Okay, so we'll simulate the portfolio and see what was to happen. So you can see now that the maximum drawdown has now gone down to minus 6.35. Okay, so we've minimized that drawdown, but also look at the return. We're now over 100% return. So we've actually been able to maximize that return. Very interesting stuff. We can also do it for things like minimum variance, maximum Sortino ratio, and we might get different weights. So for example, let's do minimum variance for these strategies, see what happens here. See how the weights have been changed. We have 65% in this one. We have around almost 10% in Crypto02, and then V3X 22%. Okay, so the weights have slightly changed for minimum variance, and we'll simulate the portfolio again and see what happens over here. Okay, so for this instance, you can see the minimum variance. The drawdown has gone up to -8, and also the total return has come down. But the investor might actually want a maximized portfolio based on minimum variance, and this would just show them exactly what that would look like and show them the results that come from it. And we can actually export this data and provide it to the investor to see what that would have looked like had they had invested in those strategies with that weight, maximizing for minimum variance. But we'll go and have a look at maximum Sortino ratio now. We'll optimize the weights for that and see what the weight looks like. Again, so we've seen the weights have changed. We've got 35% in XGB, 32% in Crypto02, and around 30% in V3X. We'll simulate the portfolio and again, see what happens over here to this data that we have. So as you can see, maximum Sortino ratio is actually the best portfolio for us. We have a very, very small drawdown of -5.5% with an overall return of 105%. So for anyone looking for maximum Sortino ratio, this would definitely print out a nice report for them. And another interesting thing about this tool that we have is all the data that it provides. If we scroll down, we'll be able to see actually the portfolio against each individual asset over time. For example, if we were to see the portfolio since inception of the March 2024, which the data is presented to us, we can compare that to the S&P 500 over time, how that has outperformed the S&P 500. We can compare it to US Treasuries. We can compare the portfolio to each individual underlying strategy that we have and see how that's performed. So we can compare it to G14 on its own. We can compare it to XGB. We can compare it to V44. We can compare it to V-Crypto02. As you can see, it's underperformed. V-Crypto02 is the only one. And then obviously V3X. So it's outperformed all of the strategies apart from Crypto02. But because it's a portfolio, we've minimized the risk and essentially maximized the reward with that. So that's the portfolio performance. We can also see the drawdown of the portfolio over time. So when these drawdowns have been hit, as you can see, the drawdowns were kept under around 1%. And then in June 2024, you can see where it exceeded that 4% mark. And then at January 2025, and then obviously recently on April 6th, it just exceeded 5%. We can compare other statistics as well, the portfolio rolling Sharpe ratio, the portfolio rolling volatility, portfolio rolling alpha to the S&P 500, portfolio rolling beta to the S&P 500, portfolio relative performance versus the assets, portfolio rolling correlation to the underlying, and then we have some optimal portfolios in 3D as well down here. So all of this data can be exported and sent out to investors to give them an idea of the strategies that they're interested in and how we could potentially optimize their capital allocation for maximum Sharpe ratio to really minimize that drawdown and maximize the returns, and give them an idea of what that would have looked like over time. If you're a partner and you're watching this, if you have any questions about this tool and how it can be used to your advantage, feel free to reach out. But yeah, I hope this video was helpful, and yeah, if you have any questions, just feel free to contact myself.